Your CPA says you made $400,000 last year. So why is there only $12,000 sitting in the operating account? If that sounds like you, or if that's about to be you, this video is going to make a lot of things click. Welcome to our videos. Welcome to our channel. My name's Artem. I'm a CPA, managing partner here at Torrent Accounting. We work and specialize in the construction industry and anything construction adjacent. So whether you're a GC, a specialty tradesman, we're here for you. We love working with you. So in the meantime, like and subscribe our channel, reach out to us. We'd be happy to talk. So why is it that you made $400,000 this year, but now you only have $12,000 in your bank account? So we're going to go over that. What we're going to find out is this is the number one thing that we see with contractors with revenue sizes between $500,000 and $20 million. So it's a pretty wide range, but it's a common question. And usually they don't get a straight answer out of their CPA, or they don't know what to ask. And so the number one thing is to start understanding that your profit, it's an opinion. So the net income on your profit and loss statement, it's an opinion. It's not a fact. Cash is the fact. So your P&L may well show a profit, but it does not mean that you have that much cash sitting in your bank account. So you always want to be careful about that. And the reason for it is there's a bunch of things that don't flow through your profit and loss statement that would lead you to believe that you have more cash than you actually do. So a couple of easy things. We're going to talk about anything like loans. So anything that you have financed, like equipment, after the initial thing, even though the cash didn't go out, you have a loan for the new truck or the new piece of equipment. Once you have that loan, it's not recognized on your profit and loan for that piece of equipment. The equipment may have been written off through depreciation expense. It might still be being written off depending on the lifespan and whether you took bonus or not. But now you have this loan to take care of that equipment for. And you know, the loan can be 12 months, 3 years, 5 years, 7 years, whatever the note is. And so now you have to pay that loan every month. And when you pay that loan, that does not reduce your net income on your profit and loss. So it's very important to understand. The interest expense on that note payment is, but the principal is not. So you got the equipment, you got the tax deduction for it, hopefully, if your CPA did it correctly. If they didn't, come talk to us. But after that, the payments for that loan will be reducing your cash in your bank account, but will not be reducing your profit on your profit and loss statement. So that's very important. Another thing that does this is owner draws. This is a very fun one. So, you know, let's say you had $400,000 sitting in your bank account. Let's pretend we're cash basis and 1 equals 1 in this scenario. We're not going to get into nerdy accounting stuff, but let's say you did have a net income of $400,000, and at one point you actually did have $400,000 in cash of net profit in your bank account. Throughout the year, you splurged a little and you bought a ski boat or a wake boat, and those things are expensive. You spend about $250,000 on it. So if you're tracking my math, you have net income in your business of $400,000, but you took out 250 grand to buy the new boat. Was it worth it? I bet it's a lot of fun. Could you have rented it? That's a different topic for a different video, but you didn't. You bought it because you wanted it. And now you have $150,000 left in the bank account, but you're still going to have to pay profit on the $400,000. So very important, owner draws do not get deducted out of your taxable income. You will have to pay tax on the entire amount of the taxable income for tax purposes. That also falls in line with estimated tax payments. So whatever your setup is, whether you're a single member LLC and you file a Schedule C with the IRS as a sole proprietor, or whether you're an S Corp, the net effect is the same. If you're paying estimated tax payments, you're paying those for your individual income tax. You're paying that through your personal tax return. So you may think, well, this tax is arising from the business, so I'll get a deduction for that tax amount. That is not correct. What's going to end up happening is your taxable income, even if you're pulling money out of it to pay taxes, you're not going to get a deduction for it. So that profit's still going to sit at $400,000, even if you made a $100,000 tax payment. So hopefully you're with me so far. We've got a couple more things to cover. I'm going to make this slightly less interesting for the duration of this video, but this is what we're here for, brass tacks. So another piece too is if you carry inventory, so if you have a yard and you buy up inventory in bulk for future jobs, that money is going to be sitting on your balance sheet. And so you're not going to get a tax deduction up until you do that job and take care of that inventory. So Very important. So if you bought $100,000 of inventory for a job and it's sitting on your yard, you're not going to get an immediate tax deduction for it. So, but the cash already went out, right? Assuming you paid cash for it. It's important. And then you're going to recognize that as cost of goods sold as you're going through that project and recognizing revenue for it. Obviously, if your customers haven't paid you, you're going to be missing some cash. If you're on cash basis, that's not going to hurt you from a taxable income perspective. But you should be looking at your accounts receivable aging, where that money is sitting. You should be working on collecting that money. Retainage is another place. Obviously, it's not that you haven't been paid. You've been paid up to the whole job. Whatever your retainage percentage is, 5, 10%. You want to keep track of retainage separately so you can make sure you get paid for that money. Tax payments I already covered, so I won't bore you to death again with that one. But credit card paydowns is another thing. So that's a common misconception. When we see people trying to do their own bookkeeping, we see that quite a lot. They think their credit card payment is going to be an expense in and of itself on their profit and loss. It's not. The way that all works is when you're charging the card, assuming it's all business, in theory, all those expenses should land on your profit and loss. So you shouldn't have this cash mismatch between your credit card statement and your profit and loss statement, right? But if you're charging anything personally on there, or if you have your personal credit card tied to your balance sheet on your QuickBooks, I hope you don't. We've seen it many times. You hate to see it happen, but it happens. Anyway, if you're paying down a personal credit card with business funds, it's just treated as an owner distribution and will not reduce your profitable income. So you're still gonna have to pay tax on that profit, and now the cash is gone for that credit card. Ski boats are expensive, and so is the gear for it. What else we got going on here? And then as you're growing, the cash can eat itself, especially if you're doing a lot of commercial jobs. So a lot of times if you're doing residential jobs, growth is easy because you come in, you bid, you get the job. A lot of times you should be asking for a deposit, or you are asking for a deposit before you start the job. And that's going to cover your initial spend on payroll for your crew, any materials you got to buy, things like that. 50% is what we see is common for residential jobs as a deposit before the job starts. Now, if you're doing commercial jobs, right, that might not be happening, and you might be waiting until the job is complete for you to get paid out. So as you're growing, you're taking on bigger jobs, assuming you don't take any deposits up front, you're going to be expending payroll costs, materials, gas for your trucks, et cetera, before you get paid. So you want to really plan on some cash flow planning so that you know what's coming before the money gets in here, so you don't get in a jam. So the fix, assuming you guys are here, you don't care about the problem, which we've covered in depth. I'm sure you guys live and breathe it. We've seen it happen, but you can actually fix it. And so how do you actually see your cash in an accurate way? Is you want to stop managing your business off the P&L alone, so off the profit and loss statement. You want to look at your bank account in comparison with your profit and loss statement. Cash flow statement, if your books are correct, will also help you decipher where the cash went, especially if you have a high profit and very little cash left over. You want to build a simple weekly cash flow snapshot. So that would be cash in, cash out, and what's coming in and out over the next 30, 60, 90 days. Super helpful. You can see, where you're going to be a month from now and what you need to plan for and what you should spend, not spend, and what collections you need to accelerate. And this is an easy fix too. So you can open up a separate bank accounts. There's some set strategies you can implement it, but you don't have to overthink it. So you can have like an operating account, a payroll account, and then a taxes account. That would be the simple way to do it. So you have 3 business bank accounts for your business. So your operating account is just the in and out, the money you get out, any supplies, materials, gas, all that stuff comes out of there. Payroll, you should know roughly what your payroll is a month. And you can have a dedicated payroll account set up. And so what you can do is, once you get your collections for the month or at the end of the month, you transfer over a set amount for payroll. So that kind of isolates it so that your payroll is covered for that month that's coming. And then the third would be taxes. So you can figure out what your net income is roughly for the month and set aside a set percentage, whatever your marginal tax rate is. If you don't know what your marginal tax rate is, we're here to help. As always, come reach out to us. You're going to love it. I promise you're going to love it. We're the greatest accountants you've ever seen. I guarantee it. And anyway, enough of a sales pitch to you guys. So you can take your operating account. One transfer you're going to do is for your payroll. So you're not worried about payroll bouncing. Very important. Never have your payroll bounce. And then 3, you take your net income, a set percentage, and you move it over to your taxes account. And what you do with the tax account is nothing. You just hold it there so that come time for quarterly estimated tax payments, your yearly tax due bill, when everything's completed, you already have the money set aside and you're not scrambling from next year's funds to pay prior year taxes. You can get fancier with that. You can have a profit account, but it's too much work. You can just use your operating account for that. But what you want to do is you want to make the money do its job. And so you just want to have a mindset shift that just because your company is showing XYZ in profit, you may not have XYZ in cash, and cash flow planning is incredibly important. Thank you for watching. If you've made it this far, tell us how, and like and subscribe, and drop us a comment at the bottom. My name's Artem. I'll see you in the next one.